The first thing I would basically like to address is, what does slippage actually mean? Hey, how's it going, everyone? Mark Anderson here, construction worker turned zero DT hedge fund manager. I know there's been a lot of talk about slippage here, and I've heard some stories about people getting $20 fills on, a $5 or $6 stop on a 50 wide spread, shopping two legs. So I just wanted to kind of go over my experience with slippage. That's the product of trading, tens of thousands of contracts, as well as research through running a zero DT hedge fund. So the first thing I would basically like to address is, what does slippage actually mean? So it seems like people have two conceptions of what this means, whereas there's one real definition of slippage. So slippage is the difference between the expected price of your trade and the actual price of the trade when is executed. I think what a lot of people get screwed up is the part that's expected price of the trade. So most people assume the expected price of the trade would be, if you put in a $3 stop and you got filled at 3.30, your expected price was $3. So therefore your slippage was 30 cents. Now, while this is important to track so we can program the correct slippage in a back test in aggregate so that our back test match our actual trade results and assumptions, that's valid. However, the real definition of slippage, and this was kind of coined by Taleb, is that it is half the bid-ask spread at the time of execution for a stop order. The bid is what someone is willing to pay. Therefore, in an efficient marketplace, the price is to cross the bid-ask to meet said buyer with seller. So expected price is actually the price to cross, the mid price when you get filled, not what you input in the trade stop loss versus what you actually get filled at. So basically, the reason we have edge in short volatility options is because we are accepting jump risk. We have accepted a limited profit for an unlimited downside, and the counterparty to us basically has continuous hedging. So when I say jump risk, that means that the price doesn't increase linearly. It can go from $3 to $4 instantaneously, and basically that jump risk, which is why there's edge, we have to pay extra money to manage that cost when the demand is greatest. So I know it's somewhat concerning what we've seen here, but jump risk is the reason why we're compensated more as sellers. So to basically show you guys an example of expected price with crossing the bid ask versus what your stop is and how that differs, the first example I'd like to give is your stop loss is set at 330. The price instantly jumps from 320 to a bid ask of 860, 1020. You are filled at 990. So the difference between 990 and 330 is 660, or you would say $6.60 in slippage. However, in the actual market dynamics, if your trigger is at 330 and the price instantly jumps from 320 to a bid ask of 860, 1020, the width of that bid ask spread is now $1.60 or 80 cents. So if you were then filled at 990, you basically paid $1.30 or 50 cents in excess of that 80 cent bid ask spread to get filled. So this is basically a 50 cent slippage. However, no one really tracks it like this. This is kind of up to the market dynamics. And I do agree that, the way automation softwares kind of track slippage on what you expect to get filled at versus what you get filled at is an important assumption for backtesting, but it's just going to be volatile and not very linear. And this is the benefit of zero DT, because the more we trade, the more that should smooth out. So personally, the last few weeks, I have experienced some volatile days of slippage. Actually, one of my worst slippage events ever, when I had over $6 of slippage on some calls about 2 weeks ago. And then the prior Friday, I took like $1.50 slippage as well. However, my slippage in aggregate over the prior month is only 17 cents, which is basically 2 cents more than I assume. So here are some other examples in regards to the bid-ask spread. And then a huge problem is, I don't think people understand what the order they're using and sending to their broker, for example, like the trigger. So let's say you collect $1 in premium and you set your stop loss at $3. One person sets the trigger on the bid. So if you are triggered at $3, and then therefore you're filled at 3.1, you basically paid 10 cent slippage across the bid ask. The other person put a trigger on the ask at $3, and therefore they're more likely to get filled sooner because their order was sent to the broker sooner. So if one person has a trigger at $3 on a bid and pays 3.10, and then the other person basically has an order at the ask and it's $2.90, $3 when they got paid, they both paid 10 cents across the bid ask. So if one was triggered on the bid and the bid ask was $3, 3.10, and they got filled at 3.10, they had 10 cent slippage. If another person was triggered on the ask and when they got triggered, the bid ask was $2.90, $3, and they got filled $3, they both paid the same slippage, $10 to cross the spread. So here the thought is that you're going to get less slippage based on what you perceive to be triggered on, the sooner you basically have that order trigger. It's not that one's wrong or the other. The real question is not how do you get better order execution from a different broker or a different trigger. The real question is what type of trigger do you want to use that will most closely match your back-tested assumptions. So in regards to our options for types of triggering orders, you have a few options. I always recommend that you go off of the bid because in an efficient marketplace, what is an option worth? What someone is willing to pay for it, and that is the bid. You could also trigger off the ask price, which basically means that you will be shopping that order the second that price is somewhat in the comparison of relevance. So if you want to most likely match your back test, you probably use the ask if you're assuming 10 cent slippage, but you could also assume 20 cent slippage and you could use the bid, and they're basically going to show exactly the same. However, the problem with the ask is someone isn't necessarily willing to pay that, so you could potentially get some nuke fills. Then there's the mid price, and the other problem with the mid price is the market makers can basically spike their bid ask spread massively, and when they spike that bid ask spread, someone is not necessarily willing to pay what is marking, and you could get filled at that. So if you want to be assured that you're not going to blow up, it's much more responsible, in my opinion, to set it off of a single bid. Then there's a last trigger, which is that means the trade was executed. This could be from a fat finger or a multitude of reasons, but again, it's not necessarily what someone is willing to get paid. So there's also the double bid, which is significantly different because that's basically assuming two parties are trying to execute an order at a reasonable amount of size at the same thing. So that's going to be lagging quite a bit. Some brokers like IB can also offer the ability to basically use a smart order. And this is basically the brokers are using kind of an algorithm to compete for the best price for you. And in general, the broker does have your best interest in mind because the more money you make, the more money you pay on commissions, the more money is in your account, the more money they make on the interest on the money that's in your account versus what they pay you. So they're generally on your side and they're there to compete for the tightest bid-ask spread in the marketplace against other market makers quoting that. Now, I wanted to go through a few examples here of what exactly these look like as well, which I think will be of benefit to all of you guys. So when we look here, you can see that this first option here is based on the midpoint, and it's going to basically a smart ordering. So this is a broker resting order that's kind of using their algo to potentially get the best price for you and not get filled at market. Then we have default price, which is going to be off of the bid. And this is just showing two different options. So you can see here that one's off the mid, one's off the bid, but they're exactly the same. It's simply just the direction we're giving to the broker. So most likely, if we're saying the price we get filled at versus the price we expect to get filled at, it'll be more than 10 cents on the mid versus the single bid. You can see that there's only a 10 cent difference in when these are triggered. However, one is triggered on an actual trade executing, while the other is being triggered on something occurring. Another example, which is E-Trade or Toss, which I know people have said they've been getting better slippage on or less slippage. And this is basically what E-Trade said is a stop quote order turned into a market order if the bid price for sell orders is equal to or lower than the stop price or ask price for a buy order. or is equal to higher to that stop price. For XYZ is trading at $55 and the stop on the quote sell is placed at 50. If the bid goes down to 50, the order will trigger. This means the market should execute at the current price or better. This could be $50 or higher. So this is an example that they're triggered off the ask. So if you're getting better slippage, it's simply that you're sending an order off of the ask instead of the bid. So you just have to factor that into your back test. But the thing is, all these orders are going to the same exchange. It's only the CBOE, and they're all competed with separate market makers. So everyone's getting the same slippage. It's just the order you sent. Could there potentially be some type of dynamic where there's so much of a crowd trying to get out on the ask that people waiting for the bid can get screwed? Potentially. But that's kind of up for debate for what you guys see in the future. Now I wanted to go through kind of the market internals and ways I like to formulate my trades that I believe come in more of a robust edge. I'll link this in the description, but effectively pages 240 through 270 in the CBOE rulebook kind of define this in some more detail. I wanted to go over my understanding from reading it. So basically, whenever the bid-ask spread spikes or at the beginning of the day, there's basically what's called an opening option where the market makers do some initial price discovery with a wider bid ask. And then basically once they reach some orders that sell and they're within a bid ask spread of an amount, they now are held to basically what's this called the composite width, which means the width of the market, i.e. the width between the composite bid and the offer of a series. And then they're kind of held to this maximum composite width. Granted, if the market is in times of turmoil, they can change this whenever they want. But you can see here that between $2 and $5, there's a maximum composite width of 60 cents. So that's basically 30 cents on each side of the bid-ask spread. And then between 5 and 10, it's 70 cents or 35% on each side of the bid-ask spread. So in regards to basically how the bid-ask spread works, we know that market makers are kind of held to a certain width on that, and it helps us make our assumptions of what slippage could be. So in options, we are assuming the jump risk when we're short volatility. And in general, this is why options have edge, because we have a defined upside and an undefined downside, and we are not protected from instantaneous jump risks if the price goes from $3 to $10 instantaneously. So this is a good thing, and this is why we make money and basically why slippage exists. Also, when the market makers are spiking their bid ask, we want to ensure we're paying a rational price. So in the options pricing formula, all of the variables of the option are basically priced or calculated off something rational. So delta is based on dollars in the money or directional exposure, and then basically gamma and theta come out of that. However, implied volatility is the only variable that is not known, and it can drastically differ, especially in the short term at certain prices. So if volatility were to drastically spike out of nowhere, this basically means that the implied volatility at the strike you're trying to shop may have gone from 20% to 80%. The bid ask went from $2 to $12. So basically you're buying extremely overpriced volatility. And this is again why options have edge. So the most accurate pricer of volatility is the at the money implied volatility, and skew means it's heightened. So if there's an 18% elevated implied volatility at the money, and then let's say you're $10 out of the money on the put side, there may be a 20% implied volatility at that strike on the put side, which means you're compensated more for the implied volatility at that strike. And this same thing basically happens if there's a $5 gap, the implied volatility could spike from 20% to 40%, which could lead to a lot of slippage. The other thing I wanted to address is, are the market makers hunting your stops? First of all, you can back test this. I pulled a log of all my stop losses, and I looked at MEIC as well. And if you basically sold the option right after it stopped, it has a negative expected return, or worse than if you just mechanically sold, that $2 option with a 1x stop every 10 minutes. The thing I wanted to also say is that the marketplace is efficient. And in general, the more people that are competing in the market for more diverse reasons, the basically harder it's going to be to collude or manipulate that market. So there's a massive amount of volume in the SPX, and there's 5 brokers competing to have people's money. So they have algorithms on their side that try to get the best price and order fills from you for the broker. Then there's multiple market makers that are trying to compete for the best price to offer on SPX. So that inevitably tightens the bid ask. And then there could also be another Wall Street firm that's basically trading the bid ask spread of the SPX versus the bid ask spreads of all of its components. So in general, the price that you pay is the price. The market has no idea what you wanted to pay. If you put a $3 stop, the market doesn't know you have a $3 stop. It just knows that once it hits $3, whatever the market is, you're willing to pay to cross the bid ask spread. I want to walk through kind of an example of basically what the plumbing works. So the internal plumbing of the bid ask and how stop orders work. So you'll always get the national bid best offer or better, no matter the exchange or the broker it is sent to. Your first orders will get filled or partially filled. The market maker will then start jockeying. As more orders come in, they keep on backing off or widening the bid ask spread. They all have different algorithms on how aggressive they would like to be to back off or basically close the gap on this bid ask spread with their predictive algos. The market makers back off slowest or have the strongest conviction for the price, which is still good, or they may actually match you to an order. It's not just random slippage. You can actually see on the level 2 quotes. Also, just be aware that level 2 quotes you are seeing are not necessarily accurate. It moves far faster than that, and whatever is refreshing on your screen has already occurred milliseconds in the past. Each matching order causes, in turn, a matching event that is sent to the market maker, and the order you are in the queue matters. So if you were to place a stop order at 9:30 and then you placed a stop order at the exact same price at 10:15, the person with the 9:30 stop is going to be faster. So this is something to note if you're using a trail stop that is constantly updated, or you're updating your stop at 2 p.m., you're technically behind everyone else that placed that option earlier, which is also why I think a lot of people may see more slippage when everyone's been stacked up on the same strike someday, and then you place a bunch of orders in power hour, and then the price jumps, and basically you're behind everyone else that has had that strike from earlier. So there's some brokers that basically have faster execution, and the order you're in the queue matters because they have better connections directly to the exchange, which have faster links to the matching engine like TDA and IBKR. So I recommend that everyone is either on TDA or IBKR, that they use a single bid order because that is in reference to what someone is willing to pay. And then also they have some type of limit stop to prevent that implied volatility spike for getting you, because the market makers, per the rule book, can basically justify whatever price they feel comfortable and fill you at that. So it's very important that you're triggered off of what someone's actually willing to pay, a bid ask, and then you're not just saying, I'll pay absolutely everything. You're saying, I'm willing to pay anything as long as it's 20 cents over what the single bid is, or I'm willing to pay up to half of my bid ask spread because I don't want to get filled at something larger than that. I also recommend everyone should use a single legged order, because if the bid ask spread on two options spikes from 5 to 15, now all of a sudden, based on that composite width, you could eat $1.50 slippage. And then also in regards to that is when you're shopping spread orders, you're buying that long and you're selling a short. So at its core, when you're buying 50-cent wings or 20-cent wings on 25 wide spreads, you're buying $25 of what you're selling that you think is overpriced. So obviously that's inefficient. And then you're going to eat that cost much more. Some other things I recommend too is that you use direct routing rather than best if it's available to you, because this is just going to help the matching engine and the orders arrive in the incoming gateway faster.